As of right now, the live price for SMX Security Matters PLC is $23.39 per share, marking a sharp intraday decline of 16.94% or a loss of $4.77. While most traders looking at a double-digit drop like this would assume the company is in a tailspin, the reality on the ground is far more complex. We aren't just looking at a typical sell-off, we're seeing a massive structural reset in the company's capital stack. Just yesterday, the firm announced it had completely wiped its corporate-level convertible debt off the map. Over $20 million in notes were converted into equity, which is exactly why you're seeing this volatility. In the world of small-cap tech, clearing the books of toxic debt is usually a long-term win, but the immediate side effect is a flood of new shares hitting the market, which is putting heavy pressure on the tape today. Most people see SMX and think of it as another high-risk penny stock play that recently found its way onto the NASDAQ, but that's a narrow view that misses the technical shift happening in the verification economy. The common expectation is that a company like this is just burning cash to stay alive. The reality is that they've spent the last few months positioning themselves as the memory of physical materials. We aren't just talking about digital tags or stickers, we are talking about molecular markers, invisible barcodes embedded directly into the atoms of gold, plastic, and even rubber. If you're using Fidelity Investments or Interactive Brokers to track these microcap movements, you've likely noticed the wild swings in volume, which today is tracking significantly higher than the average volume. This isn't just retail churn, it's the market trying to price in a company that is suddenly debt-free but significantly diluted. Let's get into the weeds of this movement, because the tension between what investors expect and what the balance sheet shows is at an all-time high. On paper, seeing a 16% drop is painful, but consider the backdrop. SMX has been plagued by convertible notes that acted as a constant anchor on the share price. By converting that $20.6 million in debt into about 1.2 million ordinary shares, the company has essentially traded immediate price stability for long-term survival. For anyone using an individual brokerage or a Fidelity trading platform to hold this, the question is no longer about when the next debt payment is due, but how quickly the market can absorb these new shares. This is a classic expectation versus reality trap. The expectation was a steady climb after they announced they were fully financed for 2026. The reality is that the path to a clean balance sheet is paved with dilution, and today's price action is the physical manifestation of that transition. Speaking of institutional activity, the volume we're seeing today on the Interactive Brokers platform suggests that the smart money is actively repositioning. While retail sentiment on the Robinhood app might be leaning toward panic selling, institutional holders often look for these clearing events where the debt overhang is finally removed. When a company clears its convertible indebtedness, it removes the restrictive covenants that usually prevent it from taking on more strategic partnerships or bigger capital raises. This is a massive development for their circular material strategy. If you look at Fidelity ETFs or broader sector funds that track industrial tech, you'll see that traceability is becoming a core requirement for global supply chains. SMX isn't just making a product, they are building a compliance layer that regulators are starting to demand. Before we go any further, I want to hear from you. Comment below how many shares of SMX you currently hold, or if you're just watching from the sidelines waiting for the bottom. Do you think the removal of debt is worth the current dilution, or is this just another hurdle for the company? The actual business model of SMX is where the storytelling gets interesting. They use a proprietary chemical hidden mark that can survive melting, manufacturing, and recycling. Recently, they've been making noise in the gold industry. Imagine a gold bar that can tell you exactly which mine it came from even after it's been melted down and turned into a wedding ring. That's the reality SMX is selling. They've also been working on plastic cycle tokens, which turn verified recycled material into a tradable digital asset. It's a bridge between the physical world and the digital ledger. For investors using SoFi Invest or Schwab Intelligent Portfolios, this kind of ESG-aligned tech usually fits perfectly into a modern, intelligent portfolio. But again, the tech is the expectation, the capital structure is the reality. If you look back at their 2025 performance, it was a roller coaster of reverse splits and compliance notices. They've had a rocky history with NASDAQ listing requirements, which is why they've been so aggressive in cleaning up the balance sheet this week. Earlier this month, they were trading significantly higher, but the volatility surrounding their equity purchase agreements and these debt conversions have kept the stock in a state of constant flux. For those into self-investing or using investing sites to find the next big multi-bagger, SMX represents the high-stakes end of the spectrum. It's the kind of stock where you could see a 50% gain and a 20% drop in the same week. The recent news about their work with precious metals is a significant catalyst that hasn't been fully priced in because of the noise from the debt conversion. They are essentially trying to solve the problem of blood gold and unethical mining by giving the metal a permanent, unhackable ID. If they can secure a major contract with a global refinery, the current market cap, which is hovering in the tens of millions, could look very different. However, the risk remains. They are a small-cap firm in a space dominated by legacy players. While the tech is superior to traditional RFID tags or paper certificates, adoption is the hurdle. For those looking at online investing options, it's important to differentiate between a company that is failing and a company that is restructuring. SMX is currently the latter. By eliminating the potential equity overhang from those convertible notes, they've made it much easier for a larger institution or a Fidelity wealth management client to actually take a look at the company without fearing a sudden collapse caused by debt. The removal of these restrictions means they can now raise capital on their own terms, which is a massive shift in power from the lenders back to the company management. Let's look at the macroeconomic pressures. We are in an environment where supply chain transparency is no longer a nice-to-have. Governments in Europe and North America are passing laws that require companies to prove the origin of their materials to avoid tariffs or fines. This is where the SMX technology meets the market. While a Robinhood stock trading user might just see a red line on their phone today, a long-term analyst sees a company that just cleared its biggest hurdle to becoming a real enterprise-grade provider. They are now fully financed through the first quarter of 2026, which gives them a runway to execute on these pilot programs without the constant threat of insolvency. As we look toward the future, the outlook for SMX depends on two things: execution and absorption. The market needs to absorb the 1.2 million new shares issued from the debt conversion. Once that selling pressure from the former note holders subsides, we will see the true market value of the company. The catalysts to watch for are new partnership announcements, especially in the steel or rubber industries, where they've already run successful pilots. If you're using Fidelity IRAs or long-term investment accounts, this might be too volatile for a core holding, but as a speculative satellite position, the story is compelling. In summary, the expectation today was that SMX would continue its upward momentum after being fully financed, but the reality of a debt-to-equity conversion is a temporary price hit. We started the day with a live price of $23.39, down over 16%, but that number doesn't tell the whole story. The real story is the elimination of $20 million in debt and the transition to a clean balance sheet. This creates a much stronger foundation for 2026 than the company has ever had. Whether you're using Robinhood Investments, SoFi Stocks, or Fidelity Brokerage, the key is to look past the intraday volatility and focus on the structural changes. SMX is no longer a company fighting for survival against its lenders, it's a company fighting for adoption in a global market that desperately needs its technology. The tension between the short-term dilution and the long-term debt-free status is exactly what creates opportunity in the stock market. If reality eventually catches up to the high expectations of their molecular marking technology, today's drop might look like a footnote in a much larger growth story. But for now, the market is doing what it does best, reacting to the immediate flow of shares. Stay focused on the volume and the upcoming pilot results, as those will be the true indicators of whether SMX can transcend its small-cap roots.